Hello and welcome to another Wealth of Advice market update on the 17th of July 2023. The world hasn't really changed much in the time I've been away. Still the turmoil in Ukraine and Russia. Obviously what's going on in the rest of the world, rising interest rates on the back of rising inflation. Maybe we've started to see a peak on inflation. There was some positive data came through last week. Everything that you're hearing in the UK at the moment just feels negative, but companies are still doing very well, etc. So I'm overall very positive as to what the next 6-12 months might look like. I think we're definitely over the worst of it. If you look at stock markets during the month of June, since the last update, global equity markets performed well in June, nearing highs in some instances to what markets might have reached back in December 2021. The FTSE 100, however, hit an all-time high in February, fell away quite sharply then. Worries over the UK economy and where interest rates are going to go and whether we're going to have a deep recession obviously weighs large on the FTSE 100, but some of the global equity markets are doing very well. The caveat to that is a lot of that rally in the US is in the tech sector, technology, and that's specifically on the back of all this stuff in the press you might have read about artificial intelligence and how Google, Apple and all these companies are rivaling each other as to who's going to have the best artificial intelligence proposition, and that's sort of certainly moving markets up. If you look just at some graphs we're putting on the screen there, you can see that Apple is currently showing year-to-date performance of being up over 52% there. Its current share price is around about $190 a share. But if you look at Apple's share price over 5 years, it's now just back to where it was at the end of 2021, 2022. Everything fell down quite heavily, but Apple is certainly getting back on the right track. Amazon put their share price on. Not so much in the artificial intelligence sector, but in the technology sector, their shares are up to $134 a share, which over the past year to date, so since January, that's 56% year to date, which is massive. But if you look at the 5-year chart, you can see Amazon is still well below where it was at the end of 2021. So as I say, some clients are looking at different stock markets and saying, well, we are almost back to where we were. When's the performance going to start coming through? Obviously, we don't invest 100% into these stocks. These are just giving you a flavour as what's going on in some of the bigger stocks. Microsoft up 44% year to date. Still, obviously, back almost to where it was. It was $342 a share on the 10th of December 2021. It's currently $345 today. So it has gone down in 2022 and recovered to where it was. Netflix, this is a very good example. You can see on the graph over the last 5 years there, fell off a cliff when it was $690 a share end of October 2021. It's currently $441 a share, but it's up 49% this year. So as I said, the big technology stocks have definitely turned and starting to move back up, and a lot of the gains you're seeing like in the S&P 500 and such like on the NASDAQ dominated by these big technology companies. What we have to hope for next is more growth to come through in the smaller stocks. And as I say, when that may be, we shall see. But I definitely think we're now over the worst of it. Economic data has suggested that consumer spending has remained resilient. Jobs report all over the world is good. You're not seeing huge job losses. Wage price growth in the UK was definitely strong in the last quarter. That in itself might have negative connotations for where inflation's going, but overall the general economy has remained quite resilient. There is predictions again that the UK is going to have this huge recession in the coming 12-18 months, but the IMF, the World Bank, predicted that in 2023 the UK would be the worst performing country in the G7. That hasn't really happened. There has definitely been some sectors that have had difficulty. Real estate, other stuff, bond markets aren't performing well, obviously, when interest rates are going up and inflation remains persistently high. So we do need to keep a good eye on where the portfolios are going in general. So as I say, a mixed bag in a sense, but it's certainly not the doom and gloom that we had in 2022 when we had the start of the war in Ukraine. We had the inflation bomb about to explode on us. We had interest rates going up, and then obviously Kwasi Kwarteng's absolutely mental budget in September. As said previously, we're not going to dwell on 2022, and we need to look forward. And as I say, the fact that the global economy has held up much better than most people expected is a definite positive thing. And this certainly plays out to the scenario where a term soft landing might be achieved, which is where you can bring down inflation by rising interest rates without killing the world. And as I say, hopefully what you're seeing across in America, its inflation figures are coming down quite nicely. Obviously, we hope to see the same in the UK. Obviously, one of the main contributors to inflation in 2022 was the price of oil and gas. If you remember, the politicians blaming everything on the war in Ukraine, the gas and oil price spiked. You can see from the chart on the screen now, when we look at the price of Brent Crude Oil, how high it got to in the early part of 2022. That has come away quite nicely in the last few months. It's gone right the way down. Anyone filling the car up with petrol and diesel will know that the price to fill your tank up is a lot cheaper than it was 12 months ago. Interestingly, and as I say, I think I put this on one of the updates a few weeks ago, supermarkets are getting some bad press recently because guess what? They were kind of colluding to keep the price of petrol high. The government has now asked them to release more data on a more frequent basis about what the input costs are for the price of petrol and diesel. And hopefully that brings back more competition in so much as to bring lower prices, and that may result in obviously lower inflation, which is good. So recording this on Monday afternoon, I noticed on I think it was the Telegraph's website this morning, one of their headlines was that UK house prices are about to crash because we've got this mortgage problem in our country where people are coming to the end of 2-year, 5-year fixed rate deals, and the new mortgage that they're going to take on will be so much higher. The graph that you can see on the screen there has shown you what the average mortgage interest rates are now for 2- and 5-year fixed rate deals. So yes, it's absolutely horrific that they've risen so much recently, but we're now back to the levels where they were in 2008. If you remember, in 2008 we had the global financial crisis, which resulted in interest rates going down to zero. That was not a normal event in history. Interest rates shouldn't be zero. So the fact that interest rates are now getting back to a long-term sort of healthy average, if you like, 4-5%, is good. It's obviously just a bit worrying that when you look at these 2-year and fixed rate deals, they've gone above 6%. Obviously, anyone who's having to pay mortgage costs on the back of cost of living rises in other areas, electric, gas, council tax, petrol, food, all those things, it's going to be hard to bear for those people. But as I say, the economy so far has proved to be quite resilient. There is still a lot of people out there with a lot of wealth behind them, whether it's in cash accounts, investments and such like, who are financially okay. So hopefully this isn't the end of the world and a huge recession. It's going to engulf the whole of the country. The graph that you can see on the screen there, where the prediction is of UK interest rates from Bloomberg data and Elston Research, who obviously we now use a lot for investment research that we look at. And as you can see, interest rates from December 2021 there have gone from 0 all the way up to 5% there. The red line is the future implied interest rate of where markets think rates are going to be. The grey dotted line is where markets predicted they would be 3 months ago. So you can see that the expectation is that we now go higher. You're hearing some industry commentators saying that we might get interest rates up to 6% in the not too distant future. But at the moment, the markets are pricing in that we'll get to around 5.5%. And then as we get towards the end of 2024, interest rates could start coming down. I put on an update, I think it was last November, after we'd heard another investment manager speak up in Scotland. We went to an event in Edinburgh, and they were saying after the last rate rise, on average in history, it's normally 6 to 8 months before rates come down. So when you hear this thing about interest rates being high, we don't believe it's going to be like the 80s or early 90s where you had 12-15% rates. There's a very good chance that once the Bank of England has achieved what it wants to do in respect of getting inflation under control, which is why they're rising rates, that will start to see them come down, and hopefully that plays out, because as I say, those people who have mortgages on variable rates, tracker rates and such like, they won't be able to afford to make those payments in the long run. So I think one of the headlines today was talking about UK property prices crashing by 25%. I think that's just a little bit of a scare story. I think property prices might come down, but like everything in life, they've gone up over a good number of months, a good number of years now. So a little bit of a pullback might not be the worst thing in the world for those people who can't afford to get on the property ladder. Across in America, similar kind of picture, if you like. This is the Fed funds rate. Again, rates have hit 5% there. And now the big guess is when will the Fed stop rising them? Some predictions may be that there's one more 0.25% rate rise left in the Federal Reserve. But their inflation data last week came through that inflation's looking really low. This is why the pound strengthened against the dollar. The pound last week was the best performing currency all over the world. And again, that's now because they believe UK rates are going to go higher. US rates might come down sooner than ours. So if you're a billionaire saver and you want to put your money somewhere, the Bank of England offer a higher rate than the US, makes the pound more favourable, and that's why the pound's strengthening. But if you look at the implied interest rate there, of where rates may go across in the US, it could be that they're back below 4% by the end of 2024, 2025. That is definitely something that I think would help markets if they come down at that point to get back to that level, because obviously lower interest rates have lower cost for businesses, lower cost for consumers, but inflation came back the way it did last year. It was a huge problem, and raising interest rates was the way that they tackled it. So just looking at inflation and the causes of inflation, obviously the governor of the Bank of England put his foot in his mouth in the autumn of last year when he said people shouldn't be accepting pay rises. I mean, what planet's that guy on? I do not know. Would he turn down a pay rise? Certainly no, on his six-figure salary as well as all the bonuses he gets. The majority of people that this graph relates to are your standard working class people who are fighting for pay rises right now. The train drivers, the teachers, the doctors, the nurses. So many industries up and down the country have gone on strike because they haven't had any pay rises for such a long time. If you look at this graph and you see the change in real wages, which is obviously how much your wage can buy because of the effect of inflation, real wages are not keeping up with inflation. It's gone negative there. So why will inflation remain sticky? Well, if you see your pay go up and it's shown there that nominal wages have gone up by 7%, but prices have gone up by 8%, well, you're going to have to spend all that pay rise just to stand still, so to speak. You've still got to buy the food, you've still got to put the electric and gas on in your property, you've still got to put the petrol in the car. So when people are getting pay rises, ultimately they're spending. The government right now is got the problem of what to do with public sector pay. I think they're wanting to offer them 5 to 6%, and obviously they want more. The train drivers are going on strike again this month because they want more. All of those pay rises coming through will keep inflation persistently sticky. And that's the big difference between ourselves and the US. If we now look across to the US and their monthly job creation, the role of the Fed, if you like, has been to get inflation down. And their wage price growth has been high, but now what you're starting to see in the month of June, and this is why markets were positive in June, is the amount of new jobs created went down. I mean, as bad as it may sound, they want to create sort of a poorer situation, so there's less jobs available, so the people aren't getting pay rises, so that no pay rises, don't spend extra, don't have inflation. And the job numbers in the US is one of the key things that the Federal Reserve interest rate policy decision makers are looking at. So the fact that it was down in June, it sounds bad, but it's actually positive, and markets liked it. So when we said at the beginning that markets were positive in the month of June, that was possibly one of the main bits of data that came through as June into July, to see markets go, because earlier on in the year new jobs being created had previously exceeded the forecasts. We now come to the final part of the presentation where we look at market performance. Historically, we've shown how certain key stock markets around the world have performed. In today's update, we're going to add to that, so apologies for the time of this update being a little bit longer, but we're going to look at other markets, bond markets, property markets, alternatives as we call them, and that includes also things like gold, commodities, cash, because they form part of everyone's multi-asset portfolio. As I say, the vast majority of our clients are invested in something between moderate or moderately speculative, which is between 40% and say 60-65% invested in the stock market. So we always focus on how those stock market funds have performed. So in this update, we're going to show a little bit more about how the alternatives do and what we think the prospects of they are going forward. So starting with stock markets, we've broke the stock market list down much wider than we often update, which we'll come on and show those separately. However, when we break markets down even further, this is from the beginning of 2023. So even the NASDAQ one, which is up 29.67% since the beginning of the year, the NASDAQ is the one that invests in US technology companies. It's up almost 30%, but still a very up and down ride over the year. So this marries up with what we said earlier on in the presentation, that those big technology companies, your Apple, your Microsoft, all those sorts of big, huge companies have done very well since the beginning of the year. Most of the portfolios will have a very small amount in the NASDAQ because it's regarded as a riskier marketplace, quite volatile. But the S&P 500 is obviously a much broader covers the American market in full rather than the Nasdaq just being the technology stocks. So as you can see, the S&P 500 up 8.46%. The Japanese market is the Nikkei 225, that's up just over 7%. MSCI World 6.75, MSCI Europe 5.88. FTSE 100, which again, if you remember previous presentations, had started to outperform other indexes around the world, buoyed by Shell, BP, the oil companies, the oil price going up during 2022. FTSE 100 looked to be the place to be, reached an all-time high in February of this year. When it got just above 8,000, it was down to 7,200 only a couple of weeks ago. So a 10% fall the FTSE 100 saw from February to June. It has recovered in the last few days, but the FTSE 100 year to date is slightly negative. FTSE World Asia minus, dominated by the fact that China has just started reopening from all of its lockdowns, and obviously any country that's been in lockdown for 3 years, it is going to take a while for things to click back to normal, but it is encouraging that China reopened. But the MSCI emerging markets at the bottom there, that's also down 2% year to date. So when you're looking at the short term over the last 6-8 months, as I say, the markets still volatile, but there is positive growth in some of the bigger markets there. When we take stock market indices over the last year, so going back full 12 months, FTSE 100, as I say, up until a few months ago was the better performing index, but then the MSCI World, that's really come up now, and the S&P 500 has dominated. So again, what we're showing you here is the value of having a multi-index portfolio, multi-asset portfolio, which can go across all of these different countries all over the world, and have the confidence and the trust in the fund managers that over the long run, they will deliver good, solid returns in the long run, albeit in the short term. And 100% get this from clients who are looking at the short-term performance going back to November 2021. It has been poor. There's been so much going on in the world. You look at 3-5 year performance of most portfolios, because the last 18 months have been quite poor, it has dragged them down. But we are confident that, as I say, we're at a point in the market where things are going to turn, and we're going to see sort of good growth coming in the future. If you look at the VIX index chart, which we're showing on the screen now, the VIX index is down around about 13. Anything below 20 is regarded as low risk market conditions, and as you can see over the last 3-5 years, when it did spike, we got well above that on a couple of occasions. Stock market indexes over the last 5 years, shown this graph plenty times. S&P 500, the MSCI World have just totally dominated, and the FTSE 100 has languished behind. FTSE 100 did very well, as I say, during 2022 when the oil and gas price went through the roof. Again, BP and Shell were the main constituents which added to that. But as you can see there, in the last few months, FTSE 100 has come away again, obviously over fears over our sticky inflation, rising interest rates, and the political situation, what's going on in the UK. We've got a general election likely in the next year or so, and there's obviously concerns over the direction that the UK is going in. So when we construct a multi-asset, multi-index portfolio for clients, we have to include lower risk asset classes. And if you go back to 2008, 2009, when interest rates went down to zero, bond markets then had a really good run for the next almost 15 years, until interest rates started going up and inflation started getting really high. Bond markets had a great time. Kwasi Kwarteng's mental budget in the back end of 2022, which if you look at bond market performance over 1 year, this chart we're putting on the screen now, you can see that pink line on the bottom there, which is the FTSE Actuaries UK Index linked. So this is tracking how UK government bonds did over that period. Really collapsed, really went down. The green line, which is the FTSE Actuaries UK conventional government bonds, that went down. So if you're looking at what was a very, very low risk asset class, over the last 12 months, government bonds have done absolutely terrible. Yes, they recovered from that mini budget that Kwasi Kwarteng did, and if you had a crystal ball and a time machine and you could go back to the end of September, after Kwasi Kwarteng had bust government bonds, so to speak, and invested on that day, you would have made money since then. However, over that 12-month period, it's very, very negative. And over the, say, last 12 months, the only place you're being able to make money in the bond market is global high yield bond. And that is the highest risk bonds that you can have of all the ones kind of listed there. If you look now at the bond market since the start of 2023, very, very uneven graph, should we say. That's what you would typically expect from stock market returns. So what we're showing you there, and why we're showing you this, is the low risk part of the portfolios are experiencing the highest risk conditions that they've had in a generation. As a result of that, most asset allocators, most fund research analysts are recommending that you reduce the amount that you have in bonds, and we've certainly done that over the last 6-9 months since we made those changes. After the budget last year, I know Trevor Greetham and the team at Royal London have totally changed how they have their bond exposure. And what this then leads to is, well, what else can we put in there? And the alternatives, historically used to just be property funds. But if we just put property in there and no other asset class, that wouldn't be very good, because as the world appears to be in some kind of slowdown and we're hoping for a soft landing, i.e. not a bad recession, property is not going to perform very well in those areas. So you have to look at other asset classes. So when we look at other asset classes, this all gets packaged into what's called alternatives. If you look at alternatives performance over 5 years, on this chart now for over 5 years, you can see gold price up 50% over the last 5 years, global infrastructure up 37%, commodities high, Bank of England base rate compared to the rest up 5% over that period of time. So yes, again, have the crystal ball in the time machine, go back to 2018. If we put all our clients' money into gold, you would have been up. However, if you look at the gold price over the last 7 months since the beginning of the year, gold has gone negative, especially since, you can see on this chart here of how gold's performed in 2023, especially since April onwards, it's gone down. Commodity prices, you can see this year is down massively, minus 12.75% this year. Global infrastructure down in minus 8.17%. So as I say, the alternatives, the low risk stuff, it's been very volatile as well. So when we're looking at performance, if you have a portfolio that has 40% in the stock market and 60% in other alternatives, bonds and alternatives, you can see why overall returns are being difficult to achieve. So what we need now as we move forward, and it's starting to happen, this is why I'm positive, is inflation figures start to peak. US CPI inflation is now down to 3%. Absolutely fantastic news. That means that the US is likely to pause rise in interest rates. Some analysts are predicting there might be another 0.25% increase, just so the Federal Reserve can say we've nailed it, we've raised rates to where they need to be. But they're hoping that rates have peaked, and then once they've peaked, maybe 6, 8, 9 months down the line, they may start to reduce them if they feel that the overall economy is starting to slow and they need to kickstart it again. So I think we're now at that period where the inflation bomb of 2022 has been fully absorbed. As a result of the inflation bomb going off, interest rates went up in the UK. And as I say, most of the portfolios we recommend have reduced the amount allocated to the UK over the last year. So although we've mentioned the FTSE 100 being a poor performer compared to the other markets this year, most of the portfolios we recommend, the Wealth of Advice models and the Royal London portfolios, for instance, has reduced its exposure to the UK. But as I say, UK, with regards what it's doing with interest rates, we're not quite there yet. We think interest rates may go up again in the next round. That's in August when the Bank of England meet again. So all this puts pressure on the bond markets and the alternatives. So as a result of that, we're looking for the stock markets to drive the returns, and that's kind of what we're hoping for. We are changing these alternatives on a regular basis and updating them. For the Wealth of Advice models, we're having our next investment committee meeting at the end of this week. Any clients who are investing in those will get an update. Royal London, they change theirs on a monthly basis. We'll record a separate update for the Royal London clients to explain what's going on with those. But overall, as I say, you can see the last 12 months, as you were aware, have been very, very choppy. And now, as I say, we look to the future and what the future might bring. The next chart we're about to show on the screen shows the relative performance of cash compared to CPI inflation over the last 10 years in the UK. And what it's showing you is the money that you hold in cash, if you'd held it in cash over the last 10 years, would have lost its value compared to inflation. You can see from August 13 to the end of 2015 into 2016, there wasn't that much of a difference. But from August 17 onwards, you can see how it's gone away because inflation started to come back slowly. And then as we got past 2021, inflation really rocketed up. So the value of cash held in the bank lost its value over time. Obviously, I'm well aware, and I'm researching this for some clients right now, that there are cash accounts out there that will give 3-4% interest, some paying 5% if you're prepared to tie it up, and that's great for an amount of savings that you have to cover you for rainy days, for emergencies. So everyone should have a percentage of their reserves in cash. Never ever going to dispute that. Obviously, over the last decade, when interest rates were virtually zero, you would have had probably on the low side kept in cash. But right now, if you've got an invested portfolio that's to be used for a drawdown in retirement, or to be you're saving on a monthly basis for your retirement, you should be invested in the markets, albeit keep the percentage back for cash. And if you do have cash accounts, we'll help you shop around, find the best rates available. I know Matthew had a discussion with a representative from an organisation at the back end of last week regarding how we can find all the cash accounts through one central portal in a much easier way. When you go online, the money supermarkets and all these sorts of stuff, a lot of them are biased in so much as some of the banks pay to be coming out top of the list and such like. So we've done a lot of research into this, but as I say, holding too much money in cash over the long run isn't a good thing. And as I say, markets hopefully get through the next few months with the volatility now behind us, the VIX index being really low, and then we move on and we get the good growth levels again that we saw over the last decade by being invested in good funds with good fund managers that will deliver over the long term. Thanks again for listening to another Wealth of Advice market update. I know this one was a little bit longer because it's been a few weeks since we recorded the last one with holidays and such like, but if any clients watching this have any queries, concerns about anything, please don't hesitate to get in touch. The next market update we'll do in 4 weeks' time. We are planning on doing a live market update whereby clients will be able to log on, watch us do this on a Zoom or Teams or something like that, but also have the ability to ask live questions as we go through that. So that's going to be mid-August. We'll send details across of the exact dates and timings and how you log on for that in the next couple of days. But hopefully, as I say, it gives it a bit more of an interactive feel, so that if anyone does have anything that they want to ask about, any graphs or charts that we're presenting, then as I said, that will be the time to do it. But please, as I say, if you have any pressing queries before then, just get in touch at any point. We're always here, text, email, telephone, anywhere that you want to get in touch, please do so. Thank you.